Alright, today is Tuesday, March 2nd. This is a post-market review of the stock market activities today. Yesterday, we asked the question, which stocks were faking a rally? Today, we got the answer, technology stocks, including growth and momentum. And the reason is that the inflationary fears that rattled the market last week are still here, and we are seeing yields elevated and getting more data supporting higher inflation. And here is a very interesting way to look at what's going on in the macro situation. I ask you to find out what's wrong with this headline from CNBC. The US economy is on fire and is about to get stoked even more. So sounds like we have an excellent economy. It's on fire. Everybody must be flushed with cash and have jobs. Oh, wait a minute. According to the Federal Reserve Chairman himself, who admitted that the real rate of unemployment is likely at or more 10%. Meanwhile, we have an economy that's quote-unquote on fire and inflation is surging higher. This is a recipe for stagflation, and this will be the theme of the coverage during the Headlines of the Day segment regarding the macro situation. As to the action in the market, today we saw a reversal to the downside, giving up a lot of the gains from yesterday's session, specifically in the technology sector. And we will take a look at all of these charts to figure out where is the next destination, in addition to covering the action that we saw in Rocket Labs with the short covering squeeze and the implications that will have on the overall market in the next few days. We will talk about that and a lot more. But for now, let's segue to see how the markets closed today. And here we go. The Dow Industrial Average closing in the red, down by 143.99 points, or a decline of 0.46%. The Nasdaq closing in the red, down 230.4 points, or a decline of 1.69%. S&P 500 also in the red by 31.53 points, or a decline of 0.81%. What about the sector's performance? Leading the pack, and the only sector of the market closing in the green today, basic materials, capturing the gold, silver, and bronze, because every other single sector of the market closed with losses, led by technology, consumer cyclicals, and real estate. Moving on to the futures market performance, we saw declines here for crude oil for a second day in a row, of course in anticipation of the upcoming OPEC meeting. What about softs? We saw gains for lumber and sugar. Meanwhile, we saw declines with coffee, OJ futures, while the action in cocoa and con future was pretty much flat and muted. What about metals? Gold finally scoring some gains here with about half a percentage point or so. We saw gains for copper, a resumption of gains of about 2% or so today. Platinum, silver, palladium closing in the green. We saw declines in the US dollar, and that is reflecting in grains gains today. Whether we're talking about soybeans, soybean meal, soybean oil, corn, wheat, rough rice, oats, canola futures, all closing in the green, led by wheat futures. But the declines in the US dollar today did not help meats. We saw massive declines for lean hogs, feeder cattle, meanwhile live cattle closing in the green. Moving on to the big casino, the options market, and let's see what happened today. Before I start, I apologize about last night's video because I showed you the list, but that list was not updated, so I presented the wrong information. So I do apologize for that. But the table you see in front of you right now is accurate and from today's action. We saw a decrease in the options volume in the market in general. It could be a result of cautiousness from market participants regarding the recent volatility. Regardless, Apple closing at number 1 with a little over 750,000 contracts, about 75% of those were calls. NIO at number 2 with a little over 600,000 contracts, about 69% of those were calls. We saw massive declines for NIO today. What about Ford at number 3? With about 400,000 contracts, about 83% of those were calls. Of course, we saw the surge in Rocket Company's options volume with about 300,000 contracts traded mostly during the last 3 hours of the day, and about 78% of those were calls. There are premiums for the options for Rocket exploded higher, whether we're talking about calls or puts due to the surge of implied volatility. We also saw some interesting action today for GameStop. I did buy the name yesterday with intention to sell upside calls to raise cash, and the name surged higher all the way to 20% gains. And today when I saw the action at Rocket, the assumption was that we're going to see money coming out of GameStop and rotating into Rocket, and therefore my diamond hands after buying GameStop only lasted for 1 day. I got out of the position because the assumption that we will see a sell-off in GameStop to raise some cash and rotate that cash to Rocket companies. And what about the unusual trades that took place in the options market today? What about the ticker GPS? This is for Gap. And somebody's making a bearish bid here by buying the 24 puts expiration date this upcoming Friday, with expectations that Gap will decline over 22% by then. They paid about 72 cents a piece to enter this trade, bringing the total to about $1 million. What about this trade for the ticker LI, Li Auto? We saw a lot of pain in the EV sector of the market today, and somebody's bidding on more declines, specifically for Li Auto, by buying the 21 puts expiration date April 1st, with the expectations that Li Auto will decline over 11.5% by then. They paid about $1 a piece to enter this trade, bringing the total all the way to $1 million. And here we have another interesting one for the ticker TOL, Toll Brothers, because somebody bought the 60 calls expiration date May 21st with expectations that TOL will gain over 11% by then, and they paid about $2.50 a piece to enter this trade, and that brought the total all the way to about $2.5 million. What about the trade at the bottom of the table for RKT, Rocket Companies? We saw the mania today. The name was up about 60%, and somebody's bidding for more gains by buying the 45 calls expiration date March 19th, with expectations that the name will climb higher over 8% by then, and they paid about $9 a piece to enter this trade, bringing the total to about $6 million. Massive bid for more gains for Rocket. Continuing with interesting trades. What about the ticker CLF? This is for Cleveland Cliffs, and the name got whacked severely the last few days. And somebody's bidding here that we found the bottom and we will see higher prices for Cleveland Cliffs, because they bought the 15.5 calls expiration date March 19th with expectation that the name will gain over 5.5% by then. They paid about 60 cents a piece to enter this trade, bringing the total all the way to about $300,000. What about the trade for the ticker AI? This is for C3. We saw massive declines for the name today, and somebody's making a massive bid here for further declines by buying the 90 puts expiration date March 19th with expectations that the name will decline over 8.5% by then. They paid about $3.75 a piece to enter this trade. That brought the total all the way to about $1.7 million. Moving on to the headlines that shape the day, starting with macro news. And the theme here, ladies and gentlemen, that we're seeing in the market is of stagflation, meaning that we are seeing higher inflation while we have not recovered employment. On one side, the economy is so hot, and on the other side, it is dead cold, fueling a massive inequality gap. And when you take a look at the rules and the signs for stagflation, well, we do have inflation, check. We have higher rate of unemployment, check. We have poor implementation of government policies, check. We do not have a recession in most of the economic activities. Matter of fact, they're roaring higher. We don't have any low GDP expectations. If anything, GDP expectations are surging higher. So you might ask yourself, then we shouldn't worry about stagflation. But here's the problem. We have high inflation, we have low GDP, but it is being manipulated along with the current state of economic activities. We have higher unemployment and we have poor implementations of government policies. So we have all conditions checked here, but the GDP and economic activities are being artificially manipulated. What do I mean by that? Here it is. How much would another round of fiscal relief do for the economy? If enacted, the proposed 1.9 trillion bill would be large enough to push GDP above the pre-pandemic trend by mid-year, meaning that the massive tsunami of liquidity from both the fiscal and monetary side is distorting the number of the GDP higher, and it is fueling a rise in economic activities. Now, remove stimulus, let's say inflation sticks due to the rise in commodities prices. Then, absent of the stimulus, the artificial floor for GDP starts to crack, and we will see GDP trending lower, economic activities trending lower, while inflation and unemployment remain high, leading for stagflation. I know that some of you guys are listening to certain propagandists over YouTube who keep telling you that the risk is actually for deflation, and bonds are going to surge higher, and continue to buy bonds. All of the misinformation, and the guy has been wrong over and over and over again. How long before you realize that you're listening to the wrong guy? You need to open your eyes and take a look at the situation, what's going on. Inflation is going higher. The risk is for higher inflation, not a lower one. Matter of fact, the risk is that we will go all the way to stagflation at some point. But anyways, whatever floats your boat, keep listening to misinformation. And here it is. The phrase commodity supercycle has become quite popular recently. The chart below shows the S&P Goldman Sachs Commodity Index is up 16.05% through February 28th. With data going back to 1973, this marks the second best start to a year on record. Only 2003 got off to a faster start. And we remember back in 03 and 04, the run or the so-called commodities supercycle and copper prices at that time. And it looks like we're about to have a mega supercycle in commodities. We are still talking about the hot side of the economy. And here is another indicator. Chase consumer card spending bounced right back higher after seeing sharp declines due to the Texas snowstorm. And we are seeing a significant uptick in consumer spending. When you print money out of thin air and you hand it to people, surprise, surprise, they will spend the money. Pandemic shopping in a nutshell. Target reported that its sales growth for 2020 for more than $15 billion was greater than the company's total sales growth over the prior 11 years. Tell me again that the risk is for de-inflation. Oh, but the supply chain and we can catch up with the demand. There's no problem whatsoever. So the risk is for de-inflation. Really? Here it is. Mentions of supply constraints in companies' earnings transcripts. You see the massive surge in both the Russell 2000 and S&P 500 companies. The supply chain is not keeping up. We're seeing demand like we have never seen before. It will take a lot of time before the supply chain starts to catch up, if ever, and things will get out of control. The risk is inflationary, not deflationary, you donkeys. Now, what about the trade deficit? We received some data regarding this issue. The U.S. merchandise trade deficit expanded to $83.74 billion in January, the second widest in records back to 1989. Once again, demand surging significantly higher, supply is not even there. We're not exporting anything. But rest assured that the Federal Reserve will conduct the right policies to contain inflation, right? Wrong. They refuse to take what needs to be taken to contain inflation and preserve the economic recovery, but that option will be bad for the markets, so the Federal Reserve decides to go on a propaganda tour. Publications from their dogs in the media and their partners in Wall Street, such as Goldman Sachs. Goldman Sachs is saying that the 10-year Treasury yields could rise to 2% without impacting U.S. equity valuations. More propaganda. They don't want you to panic. They want to lie and deceive that inflation is not there, yields shouldn't be going higher. And if they are going higher, then they're going higher for the quote-unquote right reasons. More lies and more propaganda. And of course, behind the scenes, they are taking some action by coordinating with the Australian Central Bank yesterday. And of course, right away, they started buying mortgage-backed securities, MBS. Here it is, a house of cards. Rates moved by 20 basis points, and the Fed is forced to buy $110 billion of mortgage-backed securities in 2 weeks, largest increase since May 2020. As trapped as it can be, just a tiny little bit of a surge in yields, and the Fed is already shitting their pants. And their strategy is, instead of dealing with the problem properly, let's lie, deceive, manipulate, distort, and kick the can further down the road. A dollar glut may keep Treasury yields from getting out of hand. So the genius over at the comments yesterday saying that I'm spreading propaganda for saying that the Federal Reserve is manipulating yields via manipulating the US dollar. Here it is, baby. Dollar glut may keep Treasury yields from getting out of hand. The flood of dollars that is helping to drive some US money market rates below zero could well provide a boost to international appetite for longer dated treasuries and help to cap rising bond yields at the longer end of the curve. We know that the Federal Reserve only controls the shorter end of the curve, so they need to resort to different manipulation methods to impact the end of the curve lower. Manipulation of the US dollar is one of those tools. It's all happening as we speak right now, behind the scenes. There is a reason why you saw the 10-year Treasury yield the last 2 days stabilizing, matter of fact trending lower. Things are taking place already behind the scenes. We saw that yen-hedged treasuries and euro-hedged treasuries soaring higher the last few days. Why is that? It is a result of the distortion campaign going on behind the scene from the Federal Reserve. They are shitting their pants, knowing the yields are rising higher due the massive surge of actual inflation in the economy, and they know that yields will explode higher and destroy the stock market, and therefore they have to intervene and do something about it, quote unquote. Something like sending a propaganda tour machine all through the week. Fed Governor Brain Dead expects that the burst of inflation will not last. Now they have another argument to do propaganda about. It's not that yields are rising for the good reasons. That didn't work out last week. Now they're saying, oh, yeah, we admit yields are rising higher and inflation is rising higher. We're not denying that anymore, but that is going to be temporary. So you don't have to panic and sell your stocks. They're trying to groom you and baby you to trap you into staying in the slaughterhouse. Fed Governor Brain Dead on spike in Treasury yields. Some of those moves and the speed of the moves caught my eye. I would be concerned if I saw disorderly conditions or persistent tightening in financial conditions that could slow progress toward our quote-unquote goals. Our goals. What are their goals? Nobody knows. And Brain Dead added that she isn't seeing broad-based signs of elevated asset valuations. Of course, there is a reason why we call her Brain Dead. Because here it is. Are you ready for it? We are transitioning from the hot side of the economy back to the very cold and dead side of the economy. This is still the hot. The Case-Shiller 10-City Index gained 9.8% over the year ended in December, compared to 8.9% increase in November. The 20-City Index rose 10.1% after an annual gain of 9.2% in November, meaning that the housing market is so hot, it is on fire, literally. And here is the transition to the dead cold side of the economy. The hot housing market is also causing an evictions crisis. According to a Census Bureau survey conducted last month, about 17 of renters are now behind on their payments, 3 times the typical rate. we have some tenants who did not pay rent since March of last year. Many states are still determining how to distribute money they have received from the Treasury Department to help an estimated 13 million renters. Meanwhile, Congress is poised to appropriate another $20 billion in rental assistance. An analysis from the Urban Institute found the amount of unpaid rent could exceed $52 billion. It estimated that the average delinquent household owed $5,586. Moving on to sentiment news, the sound of alarm is still there. Many are still warning that the market has entered a danger zone and market participants better be very careful. Here is from The Economist. America's bond market fears have receded again, but perhaps not for long. Get ready for more bond market scares. And here is from China. China is worried about our bubble. China is worried about bubbles in property foreign markets. China's top banking regulator said he is very worried about risk emerging from bubbles in global financial markets and the nation's property sector, sparking fresh concerns about further tightening in the world's second biggest economy. Stocks dropped across Asia. Bubbles in the US and European markets could burst because the rallies are heading in the opposite direction of their underlying economies and will have to face corrections, quote unquote, sooner or later. The chairman of the China Banking and Insurance Regulatory Commission and party secretary of the central bank said in a briefing in Beijing on Tuesday. How many titles do they give you over in China for a job? And here are more signs of concern from the sentiment in the market. Insider buying and selling. In mid to late February, insiders were getting rid of their stock at the fastest rate since November. SEC filings show purchases totaling $19.2 million, while sales were up $550 million so far this year. Insiders reported 128 million purchases and $4.96 billion in selling. The activities are heavily tilted toward the selling side. They're dumping stock like there is no tomorrow. But are the donkeys in the market at least taking some of those warnings with any degree of seriousness? Of course not. Here is from Davey Barstool. Barstool Sports founder Dave Portnoy just released a video backing a new ETF designed to track Reddit-driven social media buzz. So the mania goes on. It doesn't matter. All the signs and signals for warnings and alarms are ignored, and the maniacs go on and on and on. Davey Day Trader is rolling out an ETF this Thursday under the ticker BUZZ. It is an actively managed algo-driven ETF that scrapes social media and holds the 75 most bullishly talked about stocks. Minimum market cap of $5 billion. Sounds like a high beta spy. In a bull market, it goes higher. In a bear market, not so hot so. But of course, Davey Barstool cannot go a week without conducting a new scam. Last week, he pumped Churchill Capital, the SPAC, and we are seeing that pump already done and the dumping has started. And speaking of social media driven investing, here is shares of rocket companies. A large short target of hedge funds jumped more than 30%. By the end of the day, it closed over 60% in the green. And the reason is Wall Street Bets. The hooligans over at Wall Street Bets decided to pump rocket companies, RKT, and the reason is they figured out that it is a heavily shorted name, but the fundamentals are actually there. So perhaps the Wall Street Bets crowd is getting a little smarter. This time around, they're pumping a stock that actually has decent valuation. We saw rocket companies surging significantly higher. In addition, rocket companies issued a dividend, forcing the shorts to pay the dividend out of their pocket. And of course, all of what I did today is buying some puts for $20. These were the 25 strike. And the minute they halted the trade in RKT and it opened lower, those options doubled in value. So I dumped them right away. In, out, and I'm done with the name. I'm just watching the show for now. And of course, remember that we came very close for a market accident during the GameStop saga. Now, what do you think gonna happen with what's going on with rocket companies? We will have the market accident plus the inflationary fears working together. Very bad combination for stocks to rally. It's not gonna happen. What about the SPAC mania? What's going on? The booming in the US housing is unleashing a wave of SPAC mergers, acquisitions, and now IPO for companies that use technology to help Americans buy and sell homes. And here is more in market sentiment regarding ignoring all the warning signals, putting the blindfold on, and continue to buy. Buy. US stocks are historically expensive by many measures, but they don't look like they're in a bubble when accounting for measures of global liquidity. Hey, I might be drunk, but when you factor in the fact that I just drank the entire liquor store, all of a sudden I look very sober. This is what this donkey is saying. And of course, the zombies are stampeding to buy the market at any point. It doesn't matter that we are trading at a top right now. They are putting their blindfolds on, going Naruto style, heads first, buy first, ask questions later. Matter of fact, don't ask questions at all. And money managers have so much money on their hand because of all the stimulus and the cocaine in the market. There's so many floating all over the place. You gotta put it somewhere. And of course, money managers, they know that the market is toppy, the market is very, extremely overvalued, and you should not be buying right now, but it is not their money, and they have to put it to work somehow. So they're just dumping it and buying the stock market at bubble territories. Investors put record $86 billion into stock ETFs in February. The striking figure underscores investors' unflinching bullishness amid prospects of additional fiscal stimulus and COVID-19 vaccine rollout, alongside continued support from the Federal Reserve, at least for now, that is overshadowing any concerns about the recent surge in Treasury yields and the pressure that puts on already elevated equity valuations, especially in the tech industry. Once again, they know that they have a problem that many of us wish to have, having too much money. I know that valuations are insane, but I'm going to hold my nose and continue to pour my clients' money into buying the stock market. Why is that? Because Tina, I don't have an alternative, even though yields are rising. And of course, I know what you're going to say, but this is a reason to be long the stock market because there is so much money floating around waiting to find its way into the market, meaning that there is a massive tailwind for equities prices. Here is your homework. Google what happened back in the dot-com bubble when everybody thought that, oh, you gotta buy even at insane valuations because of the money in the sidelines. Do your homework and see what happened after the identical argument was made back in the year 2000, right before the crash. Investor psychology has shown a bias toward optimism, said Keith Buchanan, portfolio manager at Globalt Investment in Atlanta. The animal spirit, if you will, are and have been at play in the past 11 months in this rally. There is a lot of liquidity still out there, and it has found a home. BlackRock's iShare Core S&P 500 ETF, the ticker IVV, also experienced a record month after an intake of $4.8 billion, while Invesco QQQ's came in third place with $3.5 billion. Despite the volatility, where else can investors park their money? Said Mohit Bajaj, director of whatever. Bond yields have rallied so much, investors would shy away from fixed income because of the price depreciation. Equities ETFs would be the only possible substitute. Meanwhile, flows to fixed income funds paled in comparison to their equity peers, taking only $10.4 billion, the lowest since March. The $46 billion iShares iBox, the LQD, had its worst month of outflows ever, losing $3.5 billion as short interest spikes. These maniacs are taking money away from high-grade corporate bonds, and they are buying junk bonds and highly elevated equity prices. And here it is. Another fund that was recently under pressure was Cathie Wood's popular ARK Innovation ETFs, the RKK, whose biggest holding is electric car maker Tesla. The product, which surged almost 150% last year, had its worst week of outflows ever. Still, it took a net 2.4 billion in February. They have a really fervent investor base and people who believe in these companies. This big future growth style, said Ross Mayfield, investment strategy analyst at Baird. A week of underperformance is not going to break the back of these investors. It would take a lot more than that to discourage flows from going in. Perhaps the message from the bond market was not received, and we need another shock to the system for these zombies to wake up. And here is what they're doing. Bubble valuations, US stocks at the record sale multiples. Tech is back to 2000 bubble levels. We are now trading at the same highs that we reached during the dot-com bubble, but they're still pouring billions and billions of dollars every single month, buying the market, knowing that we are in a massive bubble. What kind of responsibility is this? And they're getting so arrogant. Yesterday's UVXY, this is the VIX proxy, posted a record daily outflow since inception. Historically, after outflows of 100 million, when the market is not bottoming, the SPY reversed. This kind of a pattern was present both in 2020 and 2018 correction. They are so confident that stocks only go up to the point where they don't need insurance anymore. And here's another illustration of all of this money floating around. You know that the Fed ushered the tsunami of liquidity and flooded the entire economy with fake money, and there is money floating around all over the place, begging to be deployed anywhere. And a lot of the smart money side are milking this freak show for all of its worth. Here is an example. Angelina Jolie auctioned off Winston Churchill's painting of Marrakesh for $11.6 million, nearly quadrupling its estimate. These zombies are flush with cash, and they're looking for anything. Just give them anything. What a wonderful time for any scams, SPACs, whatever. There's so much money floating around. We might as well pull some money here and start a solar dildo company. Who cares? Who cares? We IPO the company, we market it correctly, we hire Mia Khalifa, and we IPO the whole thing in the market, and there you go. The solar dildo companies at a valuation of $20 billion. Why not? There's so much cash floating all over the place, wanting to be deployed in anything at top valuations in the market, meme stocks, garbage stocks, fraud stocks, doesn't matter. Just find a way to stuff that money as it comes. Once again, it is a game of Tetris. At some point, you're gonna stuff everything higher and you will reach the top of the screen and it is game over. The mania will blow up this market. If you thought the Angie Jolie example ridiculous, here is taking it to the next level. Grimes, that is Reverend Elon Musk's girlfriend, and she sold $6 million worth of digital art. The paintings don't even exist. They only exist digitally. Once again, milk the mania for whatever it's worth. There's so much money floating around. Thank you to the Federal Reserve. And what about the 21st century's tulip mania? Bitcoin prices fall after SEC Chair nominee Gary Gensler said the agency must root out crypto fraud. And here is from Elizabeth Warren. Warren on Bitcoin. Speculative in nature may end badly. So we saw a double whammy type of day for Bitcoin. And perhaps that lifted gold prices today. Moving on to corporate specific news. And let's see what's going on here. Starting with Alibaba. Jack Ma's and defies pressure from Beijing to share more customer data. Here's more for Alibaba. Jack Ma loses title as the richest man in China after coming under Beijing's scrutiny. More trouble for Alibaba. And what about Merck? We heard news in the morning regarding the collaboration between Merck and Johnson & Johnson, and we initially saw shares of Merck trading higher in the morning, but selling off right away. It seems that even good news were not enough for Merck to rally higher. The name has been lagging the market significantly. What about Disney? Disney CEO, over 50% of our global marketplace don't have kids. 50% of the people in Disney Plus don't have kids. You really have the opportunity now to think much more broadly about the nature of your content. What is he talking about here? Are they going to add porn to Disney Plus? And more for the IPO maniacs. Instacart is now a $39 billion company, and it will probably IPO at $50 to $60 billion. But the zombies are going to stampede to buy anyways. What about McDonald's? Sexual harassment will not be tolerated at McDonald's, its CEO said, after a report detailed claims of harassment against female workers across the United States. We know that former McDonald's CEO got the boot out of the company after getting caught sexually harassing female employees. Rumor has it that the former CEO of Mickey D's used to text his female workers, "Do you want to see my big Whopper?" Oh, wait a minute, that's a different restaurant. Moving on to the souffle, Tesla. Tesla full self-driving subscription model coming in Q2, Musk says. Q2 or Q3 or Q4 or 2022, 2023, 2024, or 2025. Just like any other Musk promises. Just exaggerate and hype and push the stock higher. Who cares whether you deliver on the promises or not? Where are the robo-taxis, bro? And here's the last bit of corporate news we have today. By the end of the decade, the only Volvo you'll be able to purchase will be electric, and you'll only be able to buy it online. Soccer moms rejoice. Moving on to the heat map analysis, let's figure out which themes dominated the market today. We talked about certain sectors of the market faking it in yesterday's rally. Well, it certainly wasn't the inflationary trade, because we saw the materials sector of the market outperforming, whether we're talking about copper or gold joining the rally. We also saw industrials, financials, energy names, re-inflationary names holding ground a lot better than the technology trade. Technology, momentum, growth, you name it, got whacked severely today. We saw a massive reversal in the IPO names, Airbnb, DoorDash, and in addition to the stay-at-home trade of Zoom, Peloton, etc. We are seeing the inflationary trade and the reopening trade still dominating the market. Some of the reopening names, such as cruise lines, airlines, even casinos, were trading higher today. The predominant theme here is that inflationary fears are not over yet, regardless of the dead cat bounce we saw across the market yesterday. For now, we are sticking with the inflationary trade. Moving on to the charts analysis, starting the 15 minutes chart of the SPY. We saw the massive gap higher yesterday, and today we initially started the day higher. We started melting down and we closed at the lows of the day. What we see here is yet another topping head and shoulder formation that is supposed to take us lower. We have several destinations here for support. Number one is going down to close the gap of 383 from the gap higher in yesterday's session. If that doesn't work, what about going back 2 weeks ago and closing the gap at 376.76? So the 15 minutes chart here is showing us weakness for the SPY. Zooming out to see the big picture from the daily chart of the continuous contract, the daily chart remains bullish. We are still above the major support line of 3,862, and we are still trading above the yellow trend line. The SPY never got as weak as the Qs to begin with, and for now, the picture remains bullish to neutral until we break the 3,862 support line and we break the yellow trend line. Then we have to look down for 3,600 for support. And it is very important to differentiate between shorter timeline charts and longer timeline charts. It's also important to distinguish that the market will punish certain sectors of the market while being tamed in punishing other sectors in the market that will actually benefit from higher inflation. Therefore, the drop in the Qs will be sharper than the drop in the SPY. Speaking of, moving on to the Qs 15 minutes chart. Gapping higher in the morning, but not keeping the support of 323, quickly reversing, and that was a very important level here to defend. The Qs struggled to recapture 323 throughout the day, and we saw a bear flag consolidation that played out to the downside, and we closed at the lows of the session. The first destination to visit here is the gap at 317, and then if that doesn't work, you have to go down to retest the 313 support. If you thought that the Qs are out of the woods yesterday, think again. Zooming out to the daily chart of the futures contract for the Nasdaq. Once again, a lot of weakness here, struggling along the lines of the purple trend line. Of course, we will go down to 12,766 once again if we fail to recapture the purple trend line tonight. Moving on to the IWM, gapping higher yesterday, and everybody's assuming that we are out of the woods. What do you know? A reversal today and breaking the support of the trend line. We're going to go down to close this gap, perhaps lower. Zooming out to the daily chart, we have broken the upward trend and momentum long time ago. That was the warning signal. And now we're about to break the channel once and for all. And if we do that, and we break the trend of higher lows, it's pretty much good night, Irene. How many confirmation signals do you need? Moving on to the Dixie. We talked about Tricky Dixie yesterday, that the moment I remove my head and shoulder call, the Dixie will move lower. And indeed it did today. The question is, are we just taking a break here to visit the resistance line of 92 or to retest the support line of 90.5? Using logic, we're about to get $1.9 trillion in stimulus that will add pressure downward on the US dollar. What about gold? Finally, green day for gold, but the technical damage is still here until and unless gold recaptures 1765. Moving on to copper, we talked about an ABC pattern where copper has higher prices to go. And if copper rises higher, means that inflation will rise higher, and we will see higher treasury yields, meaning that the technology and growth trade will suffer once again. And speaking of, what about the TNX, 10-year treasury yield? Once again, we are trading lower. However, we are still elevated. And of course, this could be a short-term top before resuming higher readings all the way to 2%. And what about the VIX? The VIX bouncing higher today. And the question is, are we seeing a cup and handle formation that will lead us to higher prices? Certainly, this is my theory until and unless we close below 20. I think that the VIX has much higher prices to go. And what about Apple? 15 minutes chart. We talked about 131, but guess what? Apple reversing way before even attempting reaching 131. What does that tell us? It tells us that the support of 125 is not a solid support, and we are likely to dive down all the way to revisit the 120 support. We managed to close just slightly above 125, but the weakness is still here. What about Tesla? Tesla reversing before even reaching my target of revisiting the upper trend line in yellow, which happens to be the upper limit of the channel. Very bad reversal here for Tesla, and I do believe that we will visit 599 before we find any support. But there is a real argument here that we might have seen the top in Tesla, and we're talking about the top because the enthusiasm of buying the name and trading it via call options is still subdued. Furthermore, competition is heating up and there are more shiny objects here for retail traders to chase beside Tesla. Add to that the supply chain shortages and the inflationary pressures for commodity and raw material prices, we might be seeing the popping of the bubble here for Tesla. And now, let's take a look at charts that I discussed in talking about my trades on Twitter. Starting with Twitter. There you go. On Monday, I issued a tweet saying Twitter puts. And while we saw a massive rally in the technology sector yesterday, Twitter was lagging. It was, for matter of fact, trading in the red for the majority of the day before closing higher. And today we saw the name declining over 5%. So what am I seeing here in the chart of Twitter? Starting with the 15 minutes chart. We saw a massive reversal candle followed by a bear flag consolidation. We're starting to see the fallout from the bear flag. In addition, of course, Twitter was one of the winners 2 weeks ago when technology names were taking a beating. So it is no surprise that money will come out of Twitter to chase other laggards. But I am betting on more pain for Twitter. And for that, let's visit the daily chart and see what's going on. Number one, we have a negative crossing in the MACD imminently. We will create red impressions in the histogram in no time. Number two, we have a massive gap to fill here at the level of 60. And Twitter at some point will have to go down to close the gap at 60. Furthermore, we are seeing a negative divergence in the RSI. So there are so many technical indicators here telling us that there are lower prices for Twitter. Here is another trade I announced on Twitter for Las Vegas Sands, buying calls. And the reason is I intend on adding a casino stock in my portfolio. MGM is too high, Wynn Resorts is too weak, and Las Vegas Sands offers the best value for a potential recovery. And instead of buying the stock and taking this risk, how about buying calls? And if we indeed reach my target, then I will convert them into stock. But for now, buying in the money calls for Las Vegas Sands. What do I see here? A reverse head and shoulder formation indicating a bottom. We do have a descending line and a major resistance point at the level of 69. Now, Las Vegas Sands perhaps is not going to break that point at one shot. It could happen, but the likelihood is that it will take a few days, perhaps a pullback or two before reaching this destination. I do see LVS reaching all the way to the descending trend line, struggling, facing resistance, and then breaking higher once and for all. And what about Zoom? And by the way, the massive reversal in Zoom today was sending an important message to market participants loud and clear. The so-called stay-at-home trade is pretty much dead for all intents and purposes, including Peloton and the likes. The market is shifting toward reopening, and in my opinion, reopening is now also very overvalued. But regardless, the money is flowing away from the stay-at-home trade to the reopening trade. So let's take a look at Zoom's chart and see what's going on. Last time we talked about Zoom's chart, we talked about a head and shoulder topping formation. And that was indeed the top. And now we have a stock that is breaking the trend line and showing significant weakness and momentum in a MACD and RSI perspective, meaning that we might see further declines here for Zoom, sharp declines. But the main take is that perhaps we saw the top already for Zoom. We are not going to trade at these levels anymore for years to come. Here's the homework for the day. Take a look at the chart for Zoom, and this is the weekly chart. And compare this chart with the chart of Cisco during the dot-com bubble, and you will get exactly what I'm talking about. And here are some international ETF charts that I bought recently, starting with the RSX for the Russian ETF. We know that the Russian ETF has exposure to a lot of energy and materials companies in Russia. These two sectors will manage to outperform during the inflationary environment. Russia is a massive producer both energy and materials. We see a wedge consolidation here, a pattern that is usually broken higher, signaling the start of a new bullish trend. And here is the next one for the South African ETF. Here is why. South African stocks hit a fresh all-time high as heavyweight miners recovered from their weakness earlier in the session and banks advanced. Once again, it is an economy highly concentrated in materials, the hottest sector of the market right now. Here is the South African ETF, the ticker EZA. What do we see here? Recapturing the resistance level of 46, now support, retesting that level and bouncing higher, signaling more gains for the EZA. And here is the last international market that I bought with the ticker KSA. This is for the Saudi Arabian market, and it gives you exposure to Aramco. We know that energy prices are rising higher. A giant oil company with the lowest cost to produce, such as Aramco, will benefit tremendously from the rise in commodity prices. Once again, higher inflation is very good for energy prices, and this is one way to get exposure to one of the top beneficiaries of the rise in energy prices. And now, let's move on to conclude this video. Yesterday, we doubted the rebound in equities across the board, but we specifically pointed out that there is a set of stocks that are faking the rally higher. We now know that these were technology, growth, and momentum stocks because, once again, the macro argument remains the same. Nothing has changed regarding inflation expectations. Matter of fact, every single data we received so far in the week is pointing toward higher inflation, meaning that whatever methods of manipulation the Federal Reserve is taking behind the scenes to manipulate yields lower, that is only a temporary remedy. It's not working so good so far. It's only a matter of time before yields start snapping higher once again, and we see a resumption of the pain across the equities market, but specifically for growth stocks. We have a very interesting day ahead of us. That's all I got for you tonight, and I will talk to you again tomorrow.
If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.